Let's talk about another oscillator first, which is RSI. I know you have questions. You can go through the Q&A later. Let's talk about RSI first. Now, RSI, like I said just now, it's all about overbought and oversold. All right. When it comes to RSI, overbought and oversold is used to identify trend reversals. Uptrend becomes downtrend, downtrend becomes uptrend. Now, the RSI is simplistic, purely overbought, purely oversold. But because it is simplistic, it is not effective. Now, let me explain why. Now, when it comes to RSI, if it's RSI, unlike MACD, it's a lot more simple. You can see that RSI has a range of 0 to 100. The score can be 0, can be 100. And when the RSI line, in this case, it is the orange line in front of you, crosses above 70, right? RSI at the 70 and above, it becomes overbought. And the chat is right and type OB, overbought, more than 70. Write down in the chat, more than 70. Right? RSI more than 70. Now, when it crosses more than 70, in this case, is denoted by the pink zone, the purple zone. Above the pink zone, it is white. Above the white zone, that is the above 70 mark. That's where overbought is found. The similar, or rather the opposite is true. You can see that when the price goes back down, below the pink zone and the white zone below 30, that's oversold. Write down in the chat, OS below 30, oversold below 30. So below 30 means the price has gone very low, time to go back up. You see, this is the classic use of RSI since way back 1915, 1670s. What happens here is that back then, when the liquidity is still very small, not a lot of volatility in the market, you could easily use RSI below 30 to tell you time to get back up. Sign for strength at a downtrend. And when RSI goes above 70, goes up too much already, time to come back down. Those days, back in those 70s, 80s, and 90s, it might be useful because liquidity was smaller. Now, different. So much people trading, so much people chasing the high, so much people throwing the stocks, dumping their shares when the trend is down. Which is why in an uptrend, it is always overbought all the time. Doesn't mean it will go down, it will drop down. It can mean that it will continue to go further higher and higher and higher up. And in a downtrend, you can always see oversold happening all the time. It doesn't mean that it will go up from here. It just means that it will oversold a long time before it finally gets back up, which is why I always say RSI, overbought and oversold, not effective at all. Don't use overbought and oversold only. We have to use something else, do something else with those overbought and oversold levels in order to really optimize the whole usage of RSI. For a better effectiveness, and this is the last topic and building blocks that we have today, an advanced strategy called bullish and bearish divergence.